In today's video, I want to talk about duration for bonds or fixed income instruments. Before I get to that, let me just point out that I have a couple of other videos out there, one talking about bond valuations, one talking about current bond markets. You can check out those videos if you follow these links right here. In terms of duration, people could mean a couple of different things. So let's just walk through these two examples. One is Macaulay duration. Here is a formula for it. Feel free to pause this video if you want. I'm not going to walk you through every little detail of that formula because it's pretty similar to stuff we did in the other two videos. There is a typo there. Here's another formula for Macaulay duration. But in both cases, what we're looking at is the weighted average time to maturity, the weighted average amount of time you have to wait for a cash flow, all put into present value terms. I think it's easier to just go through an example than it is to talk about the formulas per se. Here's an example of a bond with a face value of $1,000, a coupon of $60, which means $30 every 6 months. We're going to discount it at 6%. 6% is same as 60 of 1,000. So this particular bond is priced at par right now. We're going to take a look at those present value numbers from those cash flows, and then we're going to take that and divide by the 1,000, give us kind of a percent of that current value, each of those present value cash flows. We're going to multiply that times the time in year. So if you take 29.13 divided by 1,000 times 0.5, that's where you get that 0.01. If you add all those together, you get 3.62. 3.62 being the average amount of time you have to wait for a cash flow, all in present value terms. That makes sense because not all of it is 4 years from now. This bond has a maturity of 4 years. Some of them come beforehand. If we were to increase the coupon to $100 or $50 per 6-month period, we see that the Macaulay duration drops from that 3.6 to 3.44. That's because there's more cash flow in the earlier time periods. We could also then extend this bond from that 4-year to 5-year, keeping that $100 coupon. Here we see that the duration increases from 3.44 to 4.14 because that big cash flow is further out in the future. The key points here, the things you really need to know is the lower the coupon, the longer that duration number is, and the longer the maturity, the longer that duration is. And the longer that duration is, the more sensitive that particular instrument is to changes in interest rates. That is the key point there. Well, how much? Well, that's where modified duration comes in. If we take that Macaulay duration number, we divide it by the yield to maturity over the number of periods per year. In this case, it was semi-annual, so 2 in this case. That'll give us an estimate of how much the price of that bond will change given a 1% change in interest rates. Let's do an example of that. So here we have that same bond we looked at, 5-year bond, $100 coupons, and we had that Macaulay duration of 4.14. We had the price of 11.7060. What we're saying is if we take that 4.14 divided by 1/6, that's the discount rate, but 2 times per year divided by 2, that's 1.03. We're going to get this number 4.04. That means for this bond, this priced at 11.7060, 4.02% of that is 47.06. So that means if interest rates go up by 1%, then that bond's going to decline by that 47.06 to that 11.2354. And if interest rates go down, then the bond's going to increase by that 47.06 to 1217.66. That is what this modified duration tells us. Again, feel free to pause this if you want to walk yourself through that. Duration kind of gives this weighted average, and it can also tell us how sensitive a bond is to changes in interest rates. But let's keep in mind that there is a yield curve. So all of these different maturities have different discount rates. So I use 6 in all these examples, but we could, like we did in the previous examples, in the previous videos, use a specific discount rate for each cash flow. Keep that in mind. Happy trading out there. I hope you enjoyed that. I'm Brian Kozlowski. Thank you so much.